lots of mistakes in investing their money. And the reason that they do it is because we're all human beings. Behavioral psychology comes into play, and we hate losing money. You know, any behavioral psychologist, when you talk to them about money, people just don't like, they dislike losing money a lot more than they like making money. So it's somewhat even, and as a result, it becomes very reactionary at times. And then the fourth part is really just a little bit of fun. I am from Chicago, as Dr. Brown had mentioned. And do I need that? Yeah, okay. I'm going to start all over again. Thank you. Great, thanks. Okay, is this better?
Yes.
Sounds the same to me.
It's good.
Okay, that's it. Okay. So basically, the fourth part of the presentation is going to be a test, but it's a really simple test. There's no bad grades. It's going to be one problem, and Chicago is very well known for deep dish pizza, right? I mean, anybody here from the Midwest? Yeah? Where are you from?
I was born in Milwaukee.
What?
Milwaukee,
Kenosha.
Okay.
so it's north.
I'm skipping a jump. Okay, so Chicago is pretty well known for deep dish pizza, right?
Yes, sir.
Okay, so if I'm trying to figure out how I'm going to do this, I think what I'll do is I'll give two people the opportunity to come up and represent the class, and if one of the two of you get this answer correct, I will somehow get to Dr. Brown deep dish pizza for the entire class. It'll be well worth it, and the question is not that difficult. But now you really have to pay attention, okay? So here's the wealth management industry, and this actually is both private client and institutional assets, and I hope you can.
Can we kill one
Yeah, that's
lights, or is this?
It's hard to see the numbers, right?
Yeah.
Okay.
We have control over just this bank up here?
Yeah.
Yeah, maybe even just the first bank.
Yeah, she's talking.
That's perfect. Is that right? Okay. So the point here is really that this industry today is a $23 trillion industry, which is very, very significant. And what's interesting is when you look at the private wealth component of it, which means managing money for individuals. If the entire block is 23 and that's 10, so we're almost at 50% of the available monies to invest are for private clients. By the way, the growth rate's pretty impressive. And if you look at the number of families that have over $1 million of liquid net worth, that number today is 2.9 million in America. I mean, it's staggering wealth. And when I got into this business, it was 1983. And I just couldn't imagine. I didn't know anybody that had $400,000, which was Bernstein's minimum at that time. And today, the amount of money out there is just absolutely remarkable. And I want to kind of share it with you from this perspective. If you divide up the wealth management segments, and you look at them from tier 1, but what we're going to do is we're going to actually look at tier 6 up top. And this is basically everybody that has money, but it's under $100,000. Now, if you think about this, in 2005, over 70% of the households had less than $100,000 of investable assets. Okay, I don't know what I would have expected in that space. Certainly, if I look at the the 2.5 million and above range, I'm at less than 1.5%. Excuse me, I'm at less than 1.5%. So there's a tremendous concentration of wealth in the business of under $500,000. And during our lunch conversation, there are lots of firms that are out there really focusing in on families that have 100 to 500,000. But the high net worth industry is really all competing or that $500,000 and above marketplace. That's where investment firms like Bernstein are in that space. So you probably have 100 firms that are out there competing for a little bit less than 9% of all the money. So it is a very, very competitive space. Now, why am I kind of focusing in on that? It's because it's very rare for a family to say, you know what, with my $1 million, I like you. Here's my money. You know, maybe a friend will do that with, you know, a couple $1,000, but that doesn't happen when you're really talking about big money. So what you need to do is you really need to do your homework on the industry. You need to figure out what firm you want to align yourself with, because you're going to be going up against some pretty heavy competitors. So in better understanding the industry, what you want to know is you want to have an idea of how is the wealth created. And, you know, anybody in that 16%? That's the inheritance bucket. I wasn't either. But what's really interesting is that, you know, while there's a lot of wealth that's created by business sale, this country, unlike any other, has 32% of its money created through income. The next closest country was at 18%. Now, this basically means that our executives, people in this country, make a lot of money. You know, that was kind of a surprising statistic. Investment performance, you know, that's just you know, having your assets grow over time, but income and business sales account for the majority. Now, look at this. This is actually kind of interesting. If you focus in on the equity bucket, which is the bottom, and you go back to 2002, you see that number 20%? That's low, right? Relative to what we see. That's 20% of people's monies and equities at the end of 2002. Can I ask, I just want to throw it out, does anybody have any idea why that might be the case? Why might that number in 2002 be so much lower than it is at any other point?
Possibly 9/11.
Possibly.
2001, the equities markets were on a sharp decline after several years of high growth.
Okay.
People got out of the equities markets, I imagine.
Everybody hear that?
98, that would have been a lot higher.
Okay, so the fact of the matter is that we're looking at a point in time where between 2000, 2001, and 2002, the equity markets declined by 45%. So investors got afraid. Now, I'm stating this for a reason. Fixed income is at its highest there, right? So people were taking money that they had in equities, and they were putting it in fixed income and cash, right? You see how larger those two buckets are? Now, if you think about it, that's at the end of 2002. What has happened over the last 4 or 5 years? Anybody?
A lot of growth.
From what?
U.S. equities. A lot of growth.
Okay, if you're a student of the market, what you would note is that investors, and I'm going to show you some proof of this, but investors have a tendency to be so afraid of loss that they make these irrational decisions. And when you see the data, you're going to say, I can't believe that investors actually do this poorly. But when left up to their own devices, they do, right? So you had more money in cash and fixed income at the end of 2002 than probably at any other point in the preceding 20 years, as well as the ensuing 5.
And maybe put another way, that's kind of interesting, right? Is that if people were rational and you looked at some metric of stock market valuation, P/E ratio or something like that, equities were probably, from 2007 to 97, were probably as cheap as they've been in any of that entire window. And when they had a lot of equity in 1999 or 2000, wasn't exactly what it should be,
Right.
but without reality.
Right, I mean, so did everybody got Dr. Brown's point? In a sense, individuals were doing exactly the wrong thing. Now, this, by the way, this represents everybody. You know, it's a very difficult thing when you're losing money in the capital markets to put more money into the asset class that just went down. You know, it takes, you know, it's hard. It's hard. Now, everybody loves following the winner, though, right? I mean, that's kind of human nature. So, in trying to better understand what the deliverables are in this business, what I wanted to do is I wanted to kind of share with you the way it used to be, and then I want to share with you the way that it is. Okay, so here's the old model. The old model is you had three pretty distinct, in a sense, providers in the wealth management space. You had banks, and banks for the longest time were the dominant players. You know, trust services, investment management, S&L type services. You had registered investment advisors that would then come into play and provide this level of objectivity where I'll go out and I will get you the best managers in each of the different asset classes, and we're not doing anything from a proprietary standpoint. And then you have the broker-dealers like Bernstein that say, you know what, we've got a great research platform, and from that platform, we're going to manage money. This is what's happened today. Basically, everybody's in everybody's space. Everybody is providing some of the things that they think their clients want. Okay? So from a timing standpoint, in looking at wealth management, this is a great time to take a serious consideration of this field because there's a lot of gray. You know, there are lots of players. We don't know how it's ultimately going to play out, but I'm going to make a prediction. What you see, how many, just out of curiosity, how many people wound up getting jobs or opportunities or have interned with banks? I just see them up a little higher? Okay. 5 years ago, banks would provide in-house investment services to their clients. Now, I know in Chicago, the largest bank is Northern Trust. And now what they're doing is they've established a group to go out and find outside managers that can deliver investment performance perhaps somewhat better than they've been able to deliver on their own, right? So that's the model that is now taking place, is everybody's using this outsourcing model. I put this in because, you know, there are lots of different titles for a relationship manager. And really, from this point forward, what we're going to focus in on is the job of not somebody necessarily in research, but the job of an individual who wants to be a client advisor, a relationship manager, and to kind of share with you what that could look like. Now, here's the challenge. In our business, there are really only a couple of ways to differentiate your firms and yourself professionally. You know, Bruce, tell me if I'm wrong, but to my knowledge, there are two ways that you lose clients. Number one is poor performance, and number two is poor service. Now, in most businesses, you don't necessarily have control over the performance, right? Because that's left up to the professionals who are managing money. But you certainly do on the service excellence side. Business development is becoming more and more important, but when you're moving from service to financial expertise, service excellence is typically viewed from my standpoint as a relationship-driven sale. You know, you're very good at handling relationships. My guess is that most people are. But where you ultimately become a trusted advisor and become very successful in this business is when you combine those bottom two. That's hard because you've got that third piece, business development, paying the bills. So in my firm, we have 265 financial advisors, and I would say only 10% of them have, in my opinion, crossed the trusted advisor status. Now, these are all very successful people. You know, Bernstein's private client practice today manages about $90 billion. So that's an average of about $300 million per advisor, which by any stretch is pretty good. But the best ones are able to combine those two things.
Rich, just a quick
Yep.
question that I think relates to that. Maybe you can talk to the people here about, what was your game plan on 9/12 or after we finally all realized the bubble had burst in 2001 and equity markets just tipped over? And to me, that's when you earn your stripes. If you don't have the courage to go out and face clients, then you don't belong in the business, in my opinion. Can you speak to that a little bit?
You bet. Well, a lot of it also depended upon what you were doing in advance of that. So what I would argue is any manager that was paying attention to fundamentals made a switch from what we would call more growth-oriented portfolios to more value-oriented portfolios, not in 2000, because that's perfect timing, and you know that, but in 99. So for a period of time, firms like ours looked really stupid. Because in 1999, everybody was earning a lot of money. You know what? Market was up 30-some-odd percent, 37%. We made 10% for our clients that year. So, hi, Bruce. How you doing? Good to see you. I hope you're happy with making that 10% on your money, even though you made 50% on your own.
No, I was at a cocktail party Saturday night, Rich, and everybody I talked to was up 40%. They've been buying internet stocks. What the F are you guys doing to me?
Okay. Now, by the way, unrehearsed but accurate. The fact of the matter is that was every conversation we were having. So when the bubble popped, we were on record. We actually sent clients letters because we lost 15% of our client base. In 1999, we were at 20 billion and 3 billion walked out the door. Now, you have two options, right? You can capitulate, because the reason people left is they weren't able to get technology stocks from us because we wouldn't set up a special technology fund, and we weren't owning technology stocks because they were expensive. We were a research firm. Could have left them in there for show, but you know what? If ultimately at the end of the day your job is to do what's best for clients, you're not going to do it. You're going to take the heat. Took a lot of heat. That was my worst year in business. In 2000, between 2000 and 2002 at the end, markets down 45%. The Bernstein equity portfolio is down 5%. Our business, and by the way, we were up in 2000 and 2001. We lost it and then some in 2002. But our business, from that point forward, grew from 30 billion to today it's 90. And what that tells you is how important it is for clients to not lose money. And by the way, you got to protect them against themselves because they always want to go into what's hot. Yes?
What was your explanation in 99? What did you tell them why you were only up 10% and everything else was up 40%?
Because we took all of the risk out of the portfolio. We were investing in great companies that were selling at price to earnings multiples more in the 6 to 8% range, only because nobody was buying. There wasn't anything exciting about it. And you know what? You could buy the Ciscos and the Microsofts. I remember we had a chart. This was an amazing chart because a lot of people are visual, right? And the chart was we compared Microsoft and Cisco. We looked at their earnings and we looked at the market value of those two stocks against our entire portfolio, which had 10 times more earnings, but was selling at the same price. And you go, look, you've got two baskets. This is what you're getting. Take the names off. Do you think that earnings can continue to grow at 50% a year? The answer was clearly no. So anybody that was, taking a look back could say, oh, there were all these signals. How could we have been so silly? But the fact of the matter, people got caught up in the euphoria, and it lasted for 3 years. Yes?
Would you say this is where the trust, the customer the client professional relationship played with, you know, the $3 billion that left during that time? Do you think that was like a trust issue? You also mentioned how the financial advisors, you know, only 10 of them out of the 200 or so, you know, have really built on that financial expertise and service excellence?
Yeah, I actually think that the answer is no. I think that it was a pure greed. It was a run. I mean, it was remarkable. Now, most firms that have a value tilt to them had that same experience. I think the trust part came into play when, out of the $3 billion that left, $2 billion came back. You know, they just got, you know, about a third of the money was lost, right? When they, I mean, you think about the moves that were made back then. You know, anybody who took money out of a value style in '99 and put it into growth and experienced 2000 to 2002 got killed. So that actually permanently damaged a lot of firms. There were some well-known firms in Chicago that are now out of business because of that one factor. They took people's money and put it into a style that was so expensive at the wrong time that they lost all credibility. And in our business, you lose your credibility, you're done. You got nothing else. Walks up and down in the elevators every day. That's all you got. No great technology here. I didn't know if you'd be interested in this, but I just figured I'd throw it up here anyway. This looks at you know, kind of the comp of financial planners over the past couple of years. You know, nice increases. By the way, this is only growing. So there are some pretty good opportunities in the marketplace. This is for experienced financial planners. Oh, now I got a lot of hands. No, I'm kidding. Go ahead.
What do you expect the growth rate to be into the future?
It's going to stay very high because you've also got, you know, you got the baby boomers who are coming into, you know, into their retirement ages, and they've got a lot of money. There's so much money locked up in 401k plans. The biggest thing right now, and you know, companies like Fidelity are trying to figure this out, is you manage money for IBM's pension plan, their retirement, their 401k plan. Somebody retires, where do they take that money? How do you capture what they had in their own retirement bucket so that you can move it over and start managing that money? That whole business has just started to open up. So the growth is going to be there. This is a great business.
At the beginning, you said that it's nice to be in this industry because there's a lot of gray area. What happens if firms, unlike yourself, like Merrill Lynch and so forth, capture what you had before? You know, we were talking about the growth of the salaries and you expect them to increase. How is it do you feel that you have the competitive advantage?
Against the Merrill?
Well, against any of these larger, you know what I mean?
Well, you know what? It's all business model related. You know, Bruce and I were talking about this earlier. I think we have an incredible advantage because, you know, the way that our firm's been set up is everything's based off a research platform. And all we've ever done since our firm's founding in 1967 is manage money and done very high quality research. We've never had a conflict of interest. We've never done investment banking. So what I would argue is that, you know, this Chinese wall, you know, I don't really get it, to be honest with you. You know, Chinese wall is, you know, if I'm here and you're, you know, it's like this. Do they never talk to each other? I don't know. You know, I can't make claims, but what I would argue is independent research will rule.
So you're saying that the quality of your service will, in the end, make or break. I mean, you will end up on top just because of your service.
I think our business model is the right business
Well,
model.
that's what I'm trying to get at.
So as long as performance stays good, I can go to the client and say, you know what, we're not in conflict with you. Everything we do, 100% of our revenues comes from money management. And if we're not doing something well, we're going to fix it because we don't have any place else to put that money. You know, we have to be great at this one thing. I think those kind of models are pretty powerful. The outsourcing model, which is the model that a Merrill Lynch is, you know, bringing to bear, is gaining. A lot of assets are being gained. You got to remember that model is relatively new. Right, I would argue that that's a 5 to 7 year model right now. And a lot of brokers didn't do a particularly good job of selecting stocks so to give them the benefit of doubt on selecting managers, we'll see. We'll see how it plays out. All right. So this is why the industry is so important. I'm going to go through this a little bit quicker. All right. This is an interesting chart. What you have at the top is you have the returns for major capital markets for select periods of time, starting off with the 81 to 84 period and ending with the 2000 to 2005 period. You then have the asset class that has performed best down through worst in each of those time periods. So in the period that we just discussed, which was the 97 to 99 time period, you see how growth equities were annualizing at 34.1%, and bonds were at 5.7, REITs were actually negative. Negative. If I came to you and said, I want you to invest in, I want you to take money from that growth portfolio and I want you to put it into this REIT portfolio,
NFW.
there's no way. That wasn't rehearsed either. There's no way, right? Yet, over the next 5 years, look at what happened. So you want to talk about credibility and research. You got to have the guts to make the difficult calls, because the clients aren't going to do them on their own. What they're going to do is they're going to sell out of this. They're going to take this. They're going to put it in that growth. They're probably going to sell out of this and put it in that growth. You're going to get hammered going forward. This is the proof statement.
There's a question over here, Brad.
Oh, I'm sorry.
So currently, as the REITs have performed so well over the past 5 years,
Yep.
are you guys readjusting that?
Yeah, we would actually say that that's the asset class that is most fairly valued. We never say overvalued. It's most fairly valued. This is where we are now rebalancing people into.
Do you find a lot of your clients really? Is it really difficult for you to convince them why that is important? Because to me, when I look at that chart, it seems pretty. If I was your client and you were showing that chart, I can see the patterns between just the colors and the patterns of how things are working, and I would say, well, based on historical, trends, this seems like the right thing to do. So I would trust you, but I guess you guys have more difficulty doing that. How do you?
Well, maybe you're just better.
Well, I mean, honestly, I'm understanding the financial markets, I guess, better than someone who may not be in this field. But
Right. Well, Bruce, did you
Just got a thought for Lisa and for the class. This is one of the most powerful charts we've had up on this wall since I've been in this program. Really. Lisa, just take your arm and block out the right-hand column so you can't see it. And then tell Rich you know what's going to happen in 2000 to 2005.
right,
See what I'm saying? You don't know.
true. But yeah, but the trends are there definitely.
You know what? When you're in a trend that lasts 5 or 6 years, by the way, how about 2 years ago, we were telling people that relative to value, growth was now becoming cheap. So we started to make a switch. We looked kind of silly last year, really stupid this year. You know what? Clients only have so much patience. If we knew the end dates, this would be really easy. I'd be managing a lot of money. They don't tell us that. They don't tell us that, and therein lies the problem. And the more you lose, the longer that goes on, the more aggravated you become, the more emotional you become, and then you make irrational decisions. We gained a lot of credibility with our client base to move allocations around because of the bubble. If you had a client stay with you through that bubble and they saw how right you were, you know what? Just tell me what to do. But you're always bringing in new clients and you're always going through the process of educating. But it's an amazing chart because it does. I agree with you. It just seems so obvious to me. Invest in this underperforming stuff. But I got to be honest with you. I'm trying to look for the period. So I think it was calendar year 2000. Calendar year 2000, emerging market was down about 20. Now, when you're working with somebody on their asset allocation, you're not going to have a lot of money in emerging markets because it's a really volatile asset class. So with an asset class that was down 20, you had more people at the end of the year wanting to tax trade out of it. So what you do, right, is you would sell it to offset some of the gains you would occurred in other asset classes. And then 31 days later, you theoretically buy it back. I can't tell you how many people just wouldn't buy it back. They wouldn't buy it back. They just lost 20% on it. I'm not doing it. Now, by the way, that asset class over the last 3 years has been a rock star. I mean, that asset class over the last 3 years, I think, is up 35% a year. So it's really this behavioral finance is really a big deal. Yes.
With the REIT market, there's in my opinion two types. One that actually invests in real estate, and then there's also the mortgage ones. And the mortgage ones seem to me like they're acting as a hedge fund of sorts or a mutual fund. Is that part of that bucket?
No, that's pure real estate play. Office, residential, commercial.
How do you think the mortgage REITs should they be grouped in that same bucket in general?
Well, you got mortgages, right?
Right.
Which I would say mortgages are probably more in the fixed income bucket. We would consider that in the fixed income bucket. Okay. Okay. So check this out. So remember everything I just told you. Investors are very, very reactive. A company by the name of Dalbar tracks mutual fund flows. This is actually what they do. It's a research firm. So going into the bubble, there was more money put into the U.S. stock market, as you can see by this market peak flow, than at any time in history. This is following what individuals are doing with their money. That's what this firm does. So you're saying to yourself, okay, now I get, there's this huge bubble, everybody's throwing money into it, and then all of a sudden you experience 2000. So this peak actually took place, this was like March of 2000. Then what happened is people started to lose money. Now, what's interesting is the bubble goes 2000, 2001, 2002. At the end of 2002, what this shows is there was more money put into bonds at the end of 2002 than at any other time. What happened, right? What happened after 2002? Stock market went up. So people are doing exactly the wrong things at the wrong time, which is why our jobs are so important. By the way, this doesn't change over time. This gets repeated, right? And wouldn't you say this is, Bruce, I would say that, to me, 50 to 75% of a good advisor's job is protecting people from themselves. I can
remember in '89 and '90 when you guys were on the Fat Friar and Barron's, Wall Street Journal, Economist, FT, because they were long, Citigroup and Chrysler. They had no other places to put it in the GM building. You guys were stuffed with it. Chrysler went down to less than 10. Citigroup was at 8. Both companies were clearly going out of business. People at Bernstein were idiots. What happened?
Well, we were on the front page. Our chairman was on the front page of the Wall Street Journal that said Bernstein bets big on banks. It was just, and those companies have obviously done very, very well. But I tell you what, the only way you're able to do that is with the research platform. It's the key. If you don't believe in your convictions and your research people aren't great, you can't make those types of decisions, which ultimately wind up making your clients a lot of money.
The city was a killing. You guys made a killing.
Killing on that. The Chrysler story is my favorite. Chrysler story is stock goes from, it's actually at $30, it goes down to 15 and we start buying. And it then goes from 15 to 10 and we double. It goes from 10 to 5 and we double. So the clients at that point were just crazy. And here was the research issue back then. What our research analysts had to figure out was whether Chrysler had the the net worth, whether they had the balance sheet to make it to their what was it, their 1993 car model, because they were clearly building better cars. But the reason everybody was jumping out of the stock is because they were unsure that they were ever going to be able to deliver those cars. And that's where the research team went in and met with Iacocca and his team. And later on at that point, a gentleman by the name of Kirk Kerkorian called our auto analyst and said, I love Iacocca. You guys are the largest shareholder in Chrysler. Do you mind if I come in? I would love to pay for your research.
You gotta be kidding.
And he then became the largest shareholder after us. I mean, it's just a great story of doing really, really sound research. That's why I think the business model is going to stay. So moving ahead, you have people who, right, everybody thinks they're smarter. All right, Rich.
So what happened in the end with that stock?
Well, we sold it at 55. We sold it in 1995 at 55 before it became profitable. Think about that. But it was clear that the company was going to make it. So this is what's so bizarre about stock market investing, is that when it started to make money and become profitable, which was 95 to 97, the stock went from 55 to 52. The game was over. So you could be a stock person scratching your head saying, wait a second, I timed this great. It's now making money. See, the stock market's a leading indicator, right? I mean, you got to be early before the marketplace accurately reflects what's going on. I mean, for those of you who are looking at research and portfolio management, that's a great example, because, by the time it's good, it's too late. You got to get in early. That's where most of the money's made. All right. So then you have the clients who say, you know what, I hear what you're saying, but I'm smarter. I can guess when the market's going to go down, and I know when it's going to go up. And I would just show them this chart, which I think is just beautiful. So you look at the period 1926 to 2005. Okay, 960 months. If you take the best 60 months out of the 960, you get 100% of the return of the stock market. Okay, everybody get that? In other words, in 6% of the time, you're generating basically 100% of the return. So how are you going to be good enough to know where that 6% is? The stock market now, if you believe that stat, right? I mean, what that's telling you is that, you pretty much generate all of your return in, a month and a half? It's very, very hard. This is a fool's game. This is very, very tough. Yes?
Has there ever been any research done that shows the worst 60 months compared to the best 60 months? And let's say, for some reason, you were able to be out of the market for the worst 60 months, but in the rest of it, I was wondering if there's any research on the opposite spectrum.
Yeah,
one-sided skill.
Yeah, that's interesting. I haven't seen it. I haven't seen it. Although with our research, if it had told the story we wanted to tell, we'd probably use it. So I don't know. Okay, so here's the end result. Once again, this is a Dalbar study, 1985 to 2004, 20-year period, right? Over that 20 years, the stock market was up 13.2%, as defined by the S&P 500. The average investor in stocks made 3.7%. So all this study does is it tracks flows. Right? That's buying growth at the wrong time and buying value at the wrong time. Investors don't know what. So people just can't leave stuff alone. It's an amazing statistic. We use this with every one of our prospective clients. And then the same thing for bonds.
It's even worse for bonds.
It's even worse for bonds. I mean, it's just remarkable.
Yes, certainly. The bonds are probably not. There's a tremendous amount of money came in. The equity market got spooked, and they went in cash at 75 basis points as a return. Yeah.
Yeah. I mean, so once again, what is the value of wealth management? What is the value of the relationship person in wealth management? You got to protect clients. Okay. this is actually interesting too, because what this does is it says, okay, IBM. IBM's pension plan has people who have their full-time job to evaluate money managers. And what this is saying is that when you look at the large cap equity universe from 94 to 2004, this is when the data's from, large cap equities were up 12.5, but when the professionals put managers together, they were only up 9.9 in that space. So even they can't do it right. It's really hard to do. So why is this industry so important? So I'm going to share with you, and am I, you sure?
Yeah.
Okay. So how do you think about this business the right way? All right. So if I'm advising somebody on their money, I want to have a meeting where I understand what it is they're trying to accomplish. The biggest mistakes people make on the relationship side is they don't listen. So I know that that's probably something that you're not taught in your classes. And I know that when we've sent people back to New York for training programs, all they want to do is show people how smart they are. But one of the greatest skills you can develop is one of being a good listener. Because then you can take your knowledge and address it properly. So I want to find out what people are looking to accomplish with their money. Find out what the acceptable asset class is, and then be smart about how I manage it. I want to manage it for after-tax success. So here's an example. So this is somebody who says, you know, I'd like to beat inflation by 3. I don't want to lose more than 10% of my money in any given time. I'm pretty comfortable with all the asset classes. What should we do? How should we think about this? Okay. Well, you know, you guys are a lot smarter than I am, so I'm just going to run through this stuff really quickly, right? Characteristics of stocks, right? On any particular year, stocks can have a really bad year. On average, they do pretty well, but you can see by the blue bars, you know, you can lose money by being an investor in stocks. However, this is the greatest engine for growth in the financial capital markets as well. Go to the period 1950, give me $100,000, we put it into the S&P 500, 2005, it's worth $55 million. That's where your allowance is going. It's my daughter, by the way. She's my assistant. Her first class. So it's a pretty nice growth rate, right? But look at those pitfalls. I mean, look at how many times you would have lost some serious money. And what you don't know about yourself until you've actually been through it is how will you react. If I'm losing 43% of my money, I might pull it out. It's really uncomfortable, especially if I'm spending from it. Then it's even worse. Take a look at rolling 5-year periods, right? Keep my money invested for rolling 5-year periods. You know, it's pretty solid. You're not going to lose money too often. And if you really have time on your side, which would be this 15-year period, we've never lost money in stocks over 15 years. Significance of this is the old days, when somebody retired at 65, they would be, what was this? I've read all these different things, like you take 100 minus somebody's age and you come up with their equity allocation. Wrong. Right? If you're 65, your average life expectancy is another 20 plus years. So if I've never lost money over any rolling 15-year period, I don't want to give up on this asset class because, as I just showed you, that's where my greatest opportunity for long-term growth is. And by the way, over long periods of time, this is the only asset class that beats inflation consistently. Yes?
What do you say to people that argue that that's only one history and there's no guarantee of future success just because it's always been that way? Like the same as
S&P goes. You know, in other words, there's we call it a risk premium. There's a risk. In other words, stocks are more volatile than bonds, which is why over time they've earned 4% more. So you're not going to be given that extra 4% for taking on the same kind of risk. So at some point you're going to have to take a step away, because the one thing we know is that if you put all of your money in T-bills, you'll lose to inflation. That's the one thing we know for sure. Okay. So now, why international? Okay? So, if you're not investing overseas these days, you're really missing a tremendous opportunity. Because the whole thing about investing is figuring out a way to get kind of an equal rate of return, but for less risk, or for a given level of risk, get more return. Global's done a fine job, although it has been very back-end loaded. It's done great over the last couple of years. But I'm going to give you another reason. I'm going to skip through this. Check this out. In 1970, 66% of the market cap, or the opportunities to invest, were based in the U.S. 35 years later, more than half are outside the U.S. So would you ever construct a portfolio and leave out 50% of your opportunities? What about industries? Think about that. The auto industry, 90% is outside the U.S. Can anybody tell me who the last U.S. television manufacturer was?
Apple?
I'm going with Zenith. I mean, there aren't any. TVs, we don't make TV. I mean, it's unbelievable. So a lot of really big industries, are dominated outside the U.S. So to not have exposure to them makes no sense. Why bonds? Bonds are great, right, Professor? Okay. Reduce volatility, provide income, preserve capital. I'm sure you've gone through this, but not all bonds are the same, right? There's this term called duration, right? So that'll define. What we're basically doing is we're looking at short durations and intermediate durations. They have different characteristics. Point here is as follows. Short-term bonds don't lose money. The Merrill 1 to 3, it's not down over any rolling 12-month period. Lehman intermediate, it's down, but not anywhere close to equities. So then the question becomes, how do I take all of this information I just shared and think about constructing a portfolio, right? Because now this is, so here's what I've done, right? I've gone to those of you who are interested in wealth management from an advisor standpoint and shared some data. And now I'm kind of looking at some of you who are more interested in the portfolio management aspects, right? Because you got to combine them both. You can't be good at just one. So everybody's familiar with the term correlation, and this is where most of the industry got into problems. If you were invested in U.S. growth stocks back in 2000 and you went to your broker and said, I'm getting killed, can we do something else? What they did, a lot of people did, is they took that growth and they put it into an index fund. Here's the problem. That high correlation right at the top of 1, you see where growth is? I'm sorry, I don't know why I keep doing that. It's at 0.95, which means that you're really not getting any diversification. So when you're constructing a portfolio, you have to understand how asset classes move and react with each other. What this is basically saying, if you look at currency and cash, is there's no relationship to stocks. So that's a great diversifier.
Let me make sure that.
Okay.
A little bit different, maybe the first picture, or maybe it wasn't quite sure. So if I'm running along and values outperforming growth or vice versa, and that's on the headline, that's what I read in the newspaper, and I get out of growth and into value, in my little world, I think I've done something very different. But over the history of traded markets, I've moved from one cousin
You
to
made
the
a
other.
very smart tactical decision.
Right.
This is much more long-term and strategic. Very good point. Okay, then rebalancing. Okay? This is something that people cannot do on their own. And this is just so important. And all it states is, to me, the obvious. Ready? Buy low, sell high. Is that in any of the classes? Buy low, sell high. It's really, what? It sounds so simple. Or, for me, I like to buy suits. And when I can go into a place that's having a great sale on a Xenia suit, I get very excited. And I'll go in and I'll make the purchase. When the stock market has a sale, everybody runs away. Why? So this buying low thing, while we all intuitively know it, it doesn't happen automatically. So what you have to do is you have to make sure that you're with somebody that automatically does that for you. Rebalancing is very important. And you can see here on the next page, if you look at just value and growth, when we were going through the bubble and you had started with a 50-50 portfolio, growth did so much better that value would have represented only 28% of that 100% bucket because growth had outperformed. So growth was 72, value was 28. If you didn't rebalance, you had 72% of your money going down versus 50. Okay? That's how important that was. And this point just kind of shows that, you know, by just rebalancing, and we do it within 5% guidelines. So once it got to 55, you'd rebalance it back to 50. Pretty simple. You add 40 basis points a year. It's free money. Got to be tax sensitive, right? You know, anybody that you're with on the private client side needs to be smart about taxes. And these are just some basic techniques. I don't really see the need to get into them. But you really want to think about somebody's after-tax return vis-a-vis their pre-tax return. So now we get to the last question, which was my downside risk. Okay, on the left, you've got all the calendar years in which the stock market went down. On the right, all the way right, you got investing 100% in stocks, how much the market went down by. So in my 50-50 allocation, in 1974, I lost 10-6. That was my worst year, right? Everybody clear with that? So maybe that's my starting point for a discussion with this client. If I don't want to lose more than 10%, how do you feel about 10-6? Well, I don't want to lose more than 10. Okay, then I'm going to move them a little bit more to the left. So you have definable answers for that. But then you bring into account spending. How much can I spend? This is a really big deal. So what this does is it looks at the 40 years from 65 to 2005. And if I look at a balanced portfolio on the right, I earned 9.6. I paid 1.8 in taxes. Inflation over that time period was 4.6. So I'm able to earn 3.2, right? Wasn't my goal to earn 3% over inflation? So what did I just learn? I learned what, wow, you know, okay, so my 60-40 gets me there. 60% equities, 40% bonds gets me there. But maybe that's a little too risky, right? Because my 60-40 here, I could have lost 13.9. We have a starting point. We have a discussion. And that's what you wind up doing as a good advisor. All right. So that's history. Yeah?
The allocations, what value would a relationship manager provide the advent of, say, a life cycle funds that will automatically change their allocations as you go?
Well, life cycle funds were invented, I think, as a result of the bubble to protect people from themselves. So you have none, right? Because that's self-adjusting. Those are primarily for people that are in retirement. The life cycle funds, a lot of the big 401k providers are giving those as an investment option. Those are good. Those are good. So you get no allocation advice from those, but most younger people aren't in those.
Do you have a maximum number of times that rebalance in a year to keep fees low, or whenever you target?
It's driven by the 5%. Bruce?
Real life dilemma. Could you back it up to that summary of returns on portfolio mixes again for one more. Right there.
Okay.
I've spent 3 years on the board of a 501c3 in Miami Beach trying to convince the board to create an endowment fund. Finally, we have one. We're just about to start investing, but I couldn't get them to 100% stocks. They just, I mean, I could have brought you in. I don't think you could have sold them.
Probably could.
We're at about 70-30. That's the best I could do.
Which which is
These
probably.
people that just didn't have the risk tolerance, the sophistication. This is real life stuff. I can't believe it's isolated.
Oh no, this is your job. I mean, this is what I'm doing right now is kind of to me, it's a great day in the life. It's you with a prospect, and you're or a potential client, and you're kind of talking through issues. So, how do we look at things on a going forward basis? Because everything that I've showed you is past tense. Well, we have a model, and this is where the industry's changed. The industry used to be all about averages. You know, if you're spending 5% and you're making 10%, you're in pretty good shape. But as we all know, you don't earn 10% every year, right? You get some good years and some bad years. So the term Monte Carlo came out, right? So for anybody who is into statistics or math and stuff like this is cool. I'm not, but I like it. So what this does is it's a probabilistic model. It looks at 10,000 outcomes. And it says to you, Dr. Brown, if you do want to retire, you've got a 72% chance of being able to outlive your wealth. Or you've got an 85% chance of being fine. Instead of just giving absolute numbers, which is the old way of doing it. This is the way everybody's going now. What I would argue is that when you look at what we've done, we've made it a little bit, it's a smart Monte Carlo, which basically says if inflation's at 3% right now, because Monte Carlo is random. And what a Monte Carlo could do is say, okay, if I'm looking at all these different variables, if inflation's 3, you know, maybe it'll be 18. We're not going to let that happen. You know, that's where you got to have the smart aspect to it. So on a probabilistic basis, this is why it's so important. If you look to the left, years 1 through year 8, what you see is somebody who says, okay, you know, you're going to get an average return of 10%. There's your average return number. Return path 1 is actually the 8 years ending 2002, just coincidentally, where you got a return path, compound annual return of 10, right? Path 2 is the reverse. Now, here's why the probabilistic model is so important. Because most people spend money. So if there was no money being spent, these returns would probably get you to the same point. But if I'm taking out money, and here you see I start with, I'm taking out 50,000. I start with $1 million. I'm taking out 50,000 a year, grown by inflation. Well, if I'm in path 2 and I lose money early on, I'm in trouble. I got a big problem. Anybody who retired in 2000 and invested in a balanced portfolio and was living on a fixed amount, you know, their $1 million would probably go down to 800,000 plus the 5% that they were taking out. They might have been at 7. There's no way to get back. That's why this whole probabilistic part is so important, because it looks at patterns of return.
They were not sleeping well.
They were not sleeping well. Where if you started off with path 1, you wound up with 1.8 million because your early returns were very positive. It's a 50% difference between the two. It's a big deal. How long will my money last? Well, here's interesting, because this is a great thing for a foundation or an endowment. You think to yourself, okay, I'm in a balanced portfolio, 60-40, pretty good portfolio, and I'm going to spend 5% of my money. So I have $1 million, I'm spending 50,000, I'm growing it by inflation. You know what? You got a 40% chance of running out of money. 40% chance of running out of money at a 5% spend. By the way, that's the way people used to retire. They would use that. 5% was the silver bullet. Now foundations and endowments are more in the 3.5% range. So what this does is it really helps shape the way a person thinks about risk and return. You know what? How much can I spend? What's my risk? So here, this is where we try to get people. We try to get them into the 4% spend range. So if you retire, and you retire with $2 million and you say to me, how much can I spend? It would be 4% of $2 million, 80,000 a year.
80 grand a year.
It's like, wow, that's it? Now, by the way, you can also pay your taxes on that. But think about that. $2 million is a lot of money. 80,000 spending may seem like a lot now. To somebody like Bruce, it's nothing. Okay, those are big deals. All right, so now what I want to do, yeah.
All these slides seem to be about wealth preservation. Is that the typical concern of your client? Because I'm thinking like, if I hit the lotto this weekend, I'm coming to you and I want to grow my wealth. I don't want to just preserve it.
You know, that's an easy, right? We'll just go into a growth portfolio. You know, we'll have 35% in U.S. value, 35% in U.S. growth. We'll have 25% in developed international. We'll have 5% in emerging markets. Thank you very much. That's very simple. What I wanted to do is I wanted to give you the thought-provoking issues of wealth management. Every once in a while, you get somebody who says, you know what, I've got $50 million and I don't want to take any risk. And you say, thank you very much. Here's a beautiful municipal bond portfolio for you. Very happy with that. I don't want to take. By the way, my $50 million, I'm only spending $200,000 a year. Done. I'm not running out of money. You know, so fair point.
Typical client, so?
Right. What's that?
Do you have a typical client, or can they be anywhere in the spectrum of?
Our average client has $3.5 million and is 50. We have clients that we manage in excess of $1 billion for, and then we have clients that are as small as 500,000. So it varies. Yes.
Take us through how many times do you meet face to face? Like, how's the interaction go until someone trusts you? And is there any correlation between market knowledge and how much money they have? Like, if you're dealing with someone that's $100 million as opposed to the $1 billion guy, is the $1 billion guy more educated about the market and easier to deal with?
No, but he has people who are. He has what you call a family office that is set up to do that. That's a fair question. Did I answer the first part?
Well, just like, yeah, how many, do you travel a lot? There's a lot of face-to-face. Like,
yeah. Yeah, well, I mean, we actually have it written into the contracts of our financial advisors that they have to have a minimum of 2 face-to-face meetings a year. And that's on top of, you know, not lots of phone calls, but calls as well. You don't want to, see, in my opinion, you don't want to meet with people too frequently either, because then you start focusing them in on the short term. And what you're really trying to do is make an investor a long-term investor, because that's how they ride out that sort of stuff.
Are you as bearish on the long-term prospects of the dollar as a lot of the experts are? And take that into account?
Oh, look at the trade deficit. Well, no, I mean, we've had our money, we've had the weighting on the international side 30% now for quite some time. In our institutional accounts, it's 50. We're 50-50, U.S. to overseas. So yeah, we believe that the deficit will still play a little havoc on the dollar. Yes?
You talked about the importance of listening and establishing those kind of relationships and gaining the trust, and yet you said that, let's say, only 10% of your advisors you think have that trust. Is there anything that characterizes those 10% of advisors who gain that trust? Are they?
Yeah, you know, it's interesting because you get, you know, this group has a nice advantage. And the reason that I say that is you have to have a strong appetite for learning. Most really good salespeople think they can get it done on personality. And you know what? It only gets you so far. If you combine that with really, really being value add on the capital markets, really, you know, and I tell my people, you know what? Every Sunday you should be reading some of our research. You have available to you so much information to learn more about that for you not to take advantage of it is a crime. I mean, this is your career. This is what you've chosen to do. So if you're going to do it, why not be great at it? Yes?
Similar question. You said 90% of the representatives do not combine financial expertise with service excellence.
No, you know what? Look, I'm going to get a letter from the president of my company saying, no. Let me rephrase this. Okay, we have 90% of our advisors are really good. 10% are great. That's the way. And to be really, really great, you have to be a portfolio manager type person and a personality type person in one. And you know what? Doesn't sound that hard, but it is. I mean, not that many people want to spend all that time learning. Yeah.
My question was, for you, which of that 90% do you think the majority is lacking? Which one of those qualities? The financial expertise or service expertise?
Oh, it's definitely the financial expertise. Oh, no, we hire, look, everybody I hire I want to be friends with. I mean, I like the people we hire. We hire really good people, but what they have to do, and we'll also hire people in transition. So we'll take somebody that was in maybe the technology space, we'll train them, and because they've got great problem-solving capabilities, but we'll train them in financial services. Our bet is that they're going to take that leap to really love this stuff, and they're going to really get into it. That has to happen. I don't have any more questions. Keep going? Okay. Yeah.
Would you say, I guess, is there an average difference between those that are good and those that are great in terms of their individual assets under management, how much they can bring into it?
Well, that's a great question. The great ones for us are individuals that have in excess of $1 billion on their book. The great ones are the ones who are making, solid 7 figures. The market's there to make a lot of money in this business. And what you got to ask yourself, and this is what I ask myself all the time, is if I've got the same services as the guy next to me or the woman next to me, and that person's making $1 million and I'm making $200,000, I'm not happy. I look inside, but not everybody does. It's interesting to see, from a management standpoint, it's interesting to see people's behavior. That $1 million person is obsessed with being successful. They're just obsessed with it. It defines them.
And if you, the ones that are great, the ones that manage the higher net worth investors, more so?
I'm sorry?
The greater consultants, they're the ones that more often than not have higher net worth investors within their own management.
Yeah, because that's a great point, because they're not afraid to go to the top trust and estate attorney and say, I can help you with your practice. Whereas if somebody's relationship without content, that guy's going to make me look really stupid. I'm not going in there. And that's very observant, very correct. Yes?
Sure, I'm going to say this well, so hopefully I'll understand.
Hopefully I'll listen well.
Yeah. Okay, so if you have your individual portfolio managers and they have their individual clients and they help them decide the allocations that they want, and they want this much in stocks and bonds and whatever in value stocks, does your company as a whole pick which value stocks they're invested in, or is it an individual basis? Or
Okay, great question. So here's the way we do it. So we have the asset allocation, right? And that's pretty much the work that I just showed you, which is what the advisor's responsibility is. And then under that, we have a value group, growth group, international, let's say fixed income, okay? So Bruce and I were the same age, but we view risk differently. So we each have $1 million. Bruce says, you know what, I want all of my money in growth. Not the asset. I want to grow my money really fast. So let's just hypothetically say Bruce has 350 here, 350 here, 300 here, and 0 here. And I'm 200, 200, 200, 400. Okay? So I don't want to take on the same risk Bruce takes on. His 350 and my 200 here are managed exactly the same. Same stocks, same percentages. I just own fewer shares. So this team, which takes our research and provides the best thinking in the value space, everybody shares in that.
So then you say the people that are great with the financial aspect, and I understand what you mean by service aspect, but the financial aspect, helping them allocate it correctly, is that what you mean by that?
I think everybody does a good job of it. I don't think we've hired one person who isn't good at this. What I think the next level is you have an accountant, an attorney, and a financial advisor. And I think for a wealthy family, those are your 3 key advisors. You want to be the person that they call whenever they have a major financial decision to make. It doesn't even have to be asset allocation, anything. So you have to be well-rounded. And if you're that point person, you're not going to lose that client. By the way, that client's going to tell another client and another client about how good you are. It is the greatest way to build a business. And the lawyer's going to see, wow, this guy's really good. And the accountant's going to see it. So your reputation is just going to be great. So it's not necessarily always within the asset allocation space. There's a lot of stuff going on.
What about the spending? Or whatever the market goes up, you have
Or the dollar.
$1,000.
Yeah, the dollar question.
My spending or all that kind of stuff.
Sure. Or you know, what's your thesis on the collapse of the housing market? How is that going to affect my portfolio? I don't know. Versus somebody who does know, right? You know, so it's really just being smart. I'll come back to you. Yeah.
So your job is to listen to the client and decide how they feel best and how to allocate their money, while others will decide particular stock or bond to put money in.
Correct. That's exactly right.
The tax implications on these portfolios, is it the financial advisor's job to look at the tax implication of the combined value growth, or is it
Very smart. No. That's a great question. So what I said is basically these portfolios are exactly the same. They're exactly the same until you separate somebody's financial tax situation as well as their spending. You know, if I'm spending out of mine and Bruce isn't, you may see slight differences, not in the portfolios, but you want experienced long-term gains, right? So if I need money and something is short-term, we may wait for me. We'll always wait for Bruce. So the timing's going to be a little bit different, but yeah, the individual's tax situation and cash flow needs come into play as well. Yes?
You spoke a little bit about part of your job being protecting the client from themselves in some cases. How do you capture the best asset allocation when they're telling you one thing, but you know what's best for them is a different allocation? How do you capture common ground there?
Yeah, well, first of all, it's always the client always wins. It's their money. Because at the end of the day, they can say, Rich, you're a jerk. I told you what I wanted to do, and I'm taking my money to Bruce. I want to do everything I can to be persuasive and logical through research. But at the end of the day, it's their decision.
It's a lot of give and take.
Yeah. Well, you're going when we get into this case study, you're going to see it.
I'll just offer an observation on that. Particularly if you're going after CEO type wealth, EVP, you're going after people that are successful, leaders of corporations. In my experience, they all share a lot of characteristics, one of which is they're used to getting their own way.
Absolutely right. Yes?
Just wondering, with some of your higher net worth clients with multi-millions under management, how common or infrequent is it that they have not only an advisor with Bernstein, but multiple advisors?
Yeah. So from my perspective is, you get onto what you call the institutional fee schedule at $5 million. So I don't believe that if you hire us and you've got I'm not a big fan of if somebody's got $2 million and they give me $1 million and somebody, I don't like that. Because I think that they're paying retail in a pretty big way. They get no economic economies on the fee side. When somebody has an excess of $5 million, you then, maybe it makes some sense, but that's a very individualized perspective on it. We manage money for this one family. We just got $350 million. They didn't hire anybody else. Unusual. $10 million situation where they hired two of us. I got to respect them both.
How would your responsibilities as a manager differ from like the standard portfolio manager? And what suggestions would you make to enable yourself to move, throughout your career, to move past just being the standard portfolio manager and move into management?
Are you saying a relationship manager versus portfolio manager? Because a relationship manager is doing the asset allocation, portfolio manager is managing one of those buckets.
Okay.
Which one?
I was curious as to what further education, further steps to take, things that can help you out. I mean, I guess maybe.
No. Look, it's interesting. If you're a good relationship manager / producer, like at our firm, you can make a lot of money. People don't look forward to going into management. It's almost like you do it for the company, but it's not. So, because you say to yourself, okay, so here I am, I'm a pretty successful person, and nobody's telling me what to do, because I'm good. And I'm making a lot of money. Here, I'm going to make the same amount of money, maybe less, right? Good producers always do very well. And now I'm going to have 40 people asking me why we don't have Diet Pop in the soda machine. It's like, who needs it? Now, by the way, that's true. Yeah.
In your opinion, what would you say some of your biggest competitors are in the wealth management business?
I'm going to answer that question nationally and Chicago locally. So the firms that I compete with locally on big stuff the most are Northern Trust and Goldman Sachs. Those are my two primary competitors. And I would say nationally, it's Goldman, Bessemer Trust, J.P. Morgan, definitely J.P. Morgan Chase. But it's not really the Chase part. That's too bad that it's called J.P. The elite J.P. Morgan guys, people, not the Chase people. I'm sorry.
Do the portfolio managers get most of their research from in-house, the Bernstein research, or do they go look at sell-side analysts?
It's primarily internal, but they can go anywhere.
How do you keep them so disciplined and to the fundamentals rather than chasing the hot trends in a quick money?
You know what? It's a great question. See, at Bernstein, research is a career. Our research analysts don't pick stocks ever. So when you see the reports, when you see the reports of where they rate analysts on stock picking ability, you'll never see a Bernstein person in there because they're not allowed to do it. So their job is 100%. See, at most firms, research is a way to get to portfolio management. And at Bernstein, research is a career. Portfolio management is a career, but research is a career. You could be a research analyst for 20 years and do a great job and make a lot of money, and everybody will think that you're terrific. So for them, it's all about understanding the companies in the industry that they follow. That's how they do it. There's no conflict from that perspective. Yes, sir, in the nice tie.
Thank you. Do you find that this industry is more local? For example, do you find most of your customers coming from Chicago, or is it you bringing most of them nationally?
Yeah.
Is it more of a national industry, or is it more of a specific location?
Okay, so when I started, we just had an office in New York. I started with Bernstein in 1989. We had one office. It was at 767 Fifth Avenue in New York. And we covered the whole country. So it was very national practice. And as we've grown, it's more and more clear that people like to be closer to their money. So we in Chicago deal primarily with the Midwest. It's become much more local as we've grown.
How many offices do you have today?
19. Yeah, got.
The majority of them are located. Are we talking all scattered in the Middle East, or are we talking, spread out?
All the offices?
Yes.
Well, we've got New York, we've got Philly, we've got Boston, we've got D.C., we've got, you ready for this? West Palm, Tampa, and Miami, the state of Florida, okay? Then we've got Minneapolis, Denver, Chicago, Cleveland, Detroit, Dallas, Houston, San Diego, San Francisco, L.A., and Seattle, and I hope that's close to 19. And we're expanding into Phoenix. But you know what? It gets back to the management thing. Once again, the biggest problem that a firm like ours has is good producers don't necessarily want to go into management. So I'm charged right now. I oversee the Midwest. So I've had to convince somebody to move and live in Cleveland. That's a sales job. Okay? Forget this other stuff. You take somebody from New York, you put them in Cleveland. That's selling. All right. So now I'm going to do it again with Michigan. Denver was a pretty easy fill. Phoenix is going to be a pretty easy fill. The San Diego spot had a gazillion hands up. So it really depends upon your geography. But we want to open up, we have an Atlanta office that I forgot, but we want to open up offices where, look, it's really funny. Our goal from a market share standpoint is 2.5%. If we can become a 2.5% market share holder in any location that we're in, we're huge. That's how many firms are in the business. Okay.
How is your compensation
That's fine.
Yeah.
All right, I'm not sure I heard that question. How's what?
How is your compensation based? Like, do you take a percentage of total assets?
No. I mean, I'm gonna answer that question for people in the field, right? So the way that we do it.
Yes, I was asking specific.
The way that we do it, which is very different from the brokerage firms, is we give people 40% of the revenue that they bring in for the first year, and then 10% thereafter to service it. The brokerage firms have a much richer model. They may say 40% of everything, forever. What that does, in my opinion, is it prompts brokers to build up a certain base and then be satisfied. And for a firm to grow, there has to, in my opinion, be a difference between new business and servicing. So that's our model. And we also, when somebody becomes an advisor, we give them a 6-figure salary for 4 years to hold them over until their base gets big enough for it to make sense. Yes?
In regard to rebalancing your portfolio,
right.
You had an upper trigger level of 5%, lower trigger level of 5%. How do you determine the percentage when you should rebalance?
So as soon as it gets up to, so if I'm 50-50 growth and value as an example, and growth gets to 55, bingo, it hits and I bring it down to 50. We actually, Seth Masters did a research study on it. And what you have to do is you have to look at the trade-offs between cost and the rebalance. So his research showed that 5% level was the one that made the most sense. Correct.
Following up on his question about who your top competitors were, other than the strength of your research and that your research analysts and suffer from that conflict of interest dilemma, what do you sell as your greatest advantage over them? And also, do you have any disadvantages against these competitors when you're trying to gain clients?
Yeah, okay, so what's Bernstein's biggest advantage? Other than the fact that we're never at conflict with our clients, I can point to the fact that this is all we've ever done, research and money management. This one business has something that, we now manage $660 billion. We generate revenues of pretty close to $4 billion. We're constantly reinvesting in the business. So to me, at the end of the day, if you do one thing really, really well and you continue to reinvest at it, you've got an advantage. Now, what they would say would be a shortcoming is that all of our services that we offer are Bernstein services. So what they would say is, how could you be best at everything? And what we would say is, you know what? Maybe we're not best at everything, but we're top quartile at everything. And if you can put all of that on one platform and rebalance it correctly and tax manage it well, you'll have more money than on this platform. Bruce?
Having been exposed to a lot of negative selling myself. Do some of your competitors start chewing on the Alliance Capital aspect of somehow that is...
They won't. You know what they'll do? They'll pick more on the growth product, the Alliance growth product, versus the Alliance Capital people. I mean, in a weird sort of way, Alliance Capital bought Bernstein, which is the firm that I've been with, in October 2000. And they were public and we were private. That's how that transaction occurred. But every key business unit is led by Bernstein. So the chairman and CEO is Bernstein. Retail is run by Bernstein. Private clients run by Bernstein. Institutional is run by Bernstein. So in a weird sort of way, the better management structure rose, I think. On the growth product, you know, we got, you know, we're in a bad growth cycle and we've got some issues, but hopefully that'll change. Yes?
How would you describe the lifestyle of average Bernstein employee? Wealth management?
Great. I mean, we go to great restaurants and we get massages all the time, and you know, let me see. Oh, I got to go to luxury boxes to entertain clients, and no, that's all false. No, I would say it progresses. I would say that what I tell any new person taking a job at Bernstein. By the way, when I'm interviewing somebody for a job, I want to interview their spouse or significant other. That's something that I've always done, because I want to see the interaction between the two of them when they understand what it takes to be successful. Because if I'm interviewing a great woman for a job and her husband says, "What do you mean? You got to go out and go to this charity function. You got to be at home with the kids every night." I'm going to hear stuff that's going to tell me certain things, because to me, your first 2 years in this job, it's a total commitment. It's all about you and your spouse or significant other, and if you don't have one, it's just saying, you know what, I have to commit myself to being great here because this is a wonderful opportunity. And if I don't give it my all, and I don't succeed, I don't know that I'm going to be able to forgive myself. Because you know what, there aren't many places where you have an opportunity to make 7 figures and run your own business. Just doesn't happen. You know what? To me, if that's something that I'm interested in, I really want to get after it. Yes?
How do registered investment groups affect your business?
How what?
If registered investment groups involve investment consultant analysts that make that actually provide advice.
The RIAs? Registered Investment Advisors?
Registered investment groups, yeah, advisors.
Okay.
IRAs.
Okay.
Sorry about that.
Yep.
Okay, now that we're on the same page, do they affect your business? If not you as a relationship manager, but probably the portfolio managers that Bernstein hires?
No.
Like, I know like for Morgan Stanley, for instance, they actually provide a service to institutions that pick asset managers that have performed well. So I was wondering, how much does that affect your business? You know, maybe not you personally, but somebody within your company.
So we have another group. We have a retail group, and they're the product groups to the Morgan Stanleys of the world. So I know nothing about what they do, but what the Morgan Stanley people would do is they would look at these different products and say, I want that product, I want the Bernstein value product. But it has nothing to do with our platform. Does that make sense?
So on the retail side, it's different from you.
We have wholesalers, right? So people who represent Alliance Bernstein, and they go into firms like Morgan Stanley and they say, hey, you know, we got this great fund. You should get your clients to invest in it. And then they do. But I don't even know who they are, even in my own firm. Yes?
Does your company have any large-scale plan to capture some of that retirement money that's going to become available in the next couple of years?
Yes.
Almost like a marketing plan.
Well, it's.
How do you guys go about getting plans?
What you do is you go straight to the companies. So you go to the head of HR, actually, and you ask to be a preferred provider, where you're given the opportunity to just speak to somebody and counsel on asset allocation as they approach retirement. When I was a financial advisor and we just had the New York office, I actually was able to get us into Exxon. And I wound up getting the head of HR as a client. And that way anybody who came through that was retiring with money would ask the guy, what are you doing with your stuff? Well, I got it with Bindler at Bernstein. I'm like, so, I mean, it was a nice...
Relationship manager do that? The relationship
That's
manager
your job.
Oh, that's
Yeah, that was the top part of the triangle, business generation. So we may not get to my case study. Are you okay with that? Okay, just making sure. Yes?
You all usually talk about focusing on individuals. Do you focus at all on corporations and going in and trying to do their pension funds or anything like that, or is it mostly?
We have another group. We have another group within the firm that spends all of their time going after pension plans. ERISA.
Just a follow-up question. Kurt's actually, between the retail group and your group, is the research shared, or is there independent research for each other?
Is the research shared?
I didn't know if there was independent research.
Nope. No, it's not like it's an inferior product. It's just different. It's just designed differently.
I remember 70% of the people had incomes below 100,000. What types of strategies or innovations the industry, going through to try and take advantage of that? Or is that just not in your?
We have nothing to do with that group. I think that there are lots. I mean, how many RIAs are there? There are so many RIAs. I mean, it's so easy to become an RIA that I think that there almost is as many IRAs as there are mutual funds. I think that was the stat I saw. So trust me, if there's money, there are people that are figuring out how to get after it. Yes?
Is there a significant percent of foreign investment in your client base, in Bernstein's client base?
Are we investing a lot in?
Foreign nationals.
35% of our business right now. Of the 660 is for investors that are outside of the United States. Big. And 52% of the assets we manage are global assets. It's changed so much over even just over the last 5 years.
You mentioned that the three most important people in your client's life are their accountant, their lawyer, and yourself.
Yes.
And I know you told us at lunch. I know you told us at lunch that you go to the accountants and the lawyers for referrals sometimes.
Yeah.
Do you ever have to meet with the lawyers and the accountants and get a better understanding of their professions to consult with your clients as a team?
Oh, sure. See, here's our business model. Our business model is we don't cold call. So I never, when I got out of graduate school, I didn't want to work in a job where and I had friends that were at Bear Stearns, and they were much better at it than I, where they would get these decks of cards, and they would call the cards, and if the person basically hung up the phone, they would take the card and they'd flip it, and they'd be in the back, and that was the business. So what I did, and it's what Bernstein did, is their model was always to call on trust and estate attorneys and accountants and educate them about what we were doing, learn about their practices, and then over time, see if we could help each other. So to me, for a newer Bernstein advisor, there are going to be 20 centers of influence over time that affect their careers. And they don't really need to concentrate on more than 20. They got to find the right 20, but that's it. And then you get a lot of your business from that, from the lawyers and the accountants. That's how to build it.
We've talked a lot about equity. What kind of alternative investments do you make?
Yeah, we're pretty big in the hedge fund space right now. So of our private client practice, we manage $90 billion, about 8 of it's in hedge funds, and we have about 5 different strategies. Okay. So, do I get to? Okay. So, Chicago pizza is really good.
I'm from Chicago, so if you send it to me, I can't hear it.
I'm going to send it to you. Right, okay. So, Dr. Brown's going to be my conduit here to the pizza. This could be really a lot of pizza. So, how many people have an HP calculator? Or any kind of, all right, so we got representation, we're good, okay. Because I think you're going to need a calculator for this one. All right, so here's the way this is going to work. I'm going to give people 10 minutes, the class 10 minutes to figure this out. You may not need a calculator. All right? And then I'm going to allow 2 people to raise their hands, to come up to the board to share their answer. If either of the 2 gets it correct, I will be FedExing about 15 really good deep dish pizzas for the group, for anybody who was in attendance today, okay? So I'll figure out the best way to get that done with Dr. Brown. Now, everybody should have this sheet. Okay? So here's what you need to know. This is kind of it's a crib sheet. So at the top of the crib sheet, what you have is you have the graph that looks at after-tax returns on the horizontal axis and spending percentages on the vertical. And basically, just as an example, if I'm spending 5% of my money, but I'm earning 7.5% after tax, my money will last for 40 years. That means I won't run out of money. Once you hit 40, you don't run out of money. Okay? So you're going to have to trust me on that. Then the bottom box is taking for you the different allocations between stocks and bonds. And all you need to do is look at the AT, the after-tax returns. Okay? And the risk levels. So basically what the risk level, I've already computed the 2 standard deviation event. So just know that this is the level of risk. So if I say I don't want to lose more than 4% of my money, you now know that I can invest 20% in stocks, 80% in bonds, right? Right. Okay, good. I was waiting for that. So here it is. Here's the question. You are now all financial advisors. And here's your client profile. It's a 47-year-old who wants to retire in 8 years, spends $25,000 a month after tax, currently has $4 million. If they want to spend 4% of their money and inflation is 3%, how much money do I need to save over the next 8 years, assuming I don't want to lose more than 12% in any given year? You have everything you need with you. Good luck to the class.
Is that 25K now or in 8 years?
What's that?
Is that 25K?
I'm not answering, I can't answer questions, I mean, look at all the pictures I got.
Quick shot.
You got a big financial risk on this.
Is there any chance I could use
Okay, we got 2 minutes to go. Does anybody think anybody want to give it a shot? Anybody ready yet, or should I wait a little bit? There's no downside here.
No sunk cost, nothing.
Anybody? By the way, you can come up in a group. It doesn't matter if you want to come up as multiple people to kind of share in the responsibility. I'm okay. Anybody? Want to give it this? What's that? Come on up. Absolutely. So you want to just talk people through what you're doing?
It's not going to be like present value and all that stuff.
It is present. It is present value.
Well, I know 50. I'm pretty sure 53. You're going to need 4,687,500. Or 55. 55. Right. I just thought you were shooting at 55.
Okay. Not exact. I want to see what you did, but let me see if somebody. Okay. Hold up. No downside here. Once again, just glory.
John, you guys have a consensus meeting?
What?
You guys are on date? Big night, you guys have a consensus? We're all disagreeing.
Can we pick the average of 3?
You want to go?
You guys have different answers?
Yeah.
All right, you're my 2 bullets.
Come on down, come on down.
Yeah, give it a shot.
Chris, give it a shot. John, you guys shot it? Give it a shot.
You're coming at the same time.
I'll duel.
You'll duel? You'll take respective blackboards?
This was done on a cell phone calculator, by the way, so hopefully there are no significant figures.
5.5 mil in water cost.
What's that?
5.5 mil future value transfer.
Not the way I set it up.
You want me to go through the process?
Well, let me ask a question. Did anybody get? Well, all right, let's do it this way. Maybe the best way to do it is how did people start thinking about this? What was kind of like your first? What's the first thing you did? What's that? Okay, all right. So here, you can help me up here. Okay, just keep you up there. Great. All right. So we got risk, right? And the risk was 12%. All right. Didn't want to lose more than that. So what was my return number? Thank you. Okay, that's absolutely correct. Okay. Did anybody think about the spending? Anybody start off with spending? Okay, I'd love to hear. Anybody who started off with spending, I'd love to hear what you did. I can't hear. I'm sorry, I didn't hear. What'd you do?
I did 25,000 times 12 gives you 300 a year, and your
assets need to generate at least 300 a year, so your return's got to equal, your capital times your return's got to equal at least 300 a year.
Okay, did anybody grow spending with inflation?
Yeah. Yes.
Who grew, all right, so go ahead. Who grew it?
Can I just write mine on the board? Because I really think I'm right.
You're right there? You're feeling good about it? Go ahead, come on up. Go ahead. Not only that, I'll pass you the chalk.
I need $7.5 million for 4% for
Well,
$30K a year.
Show me, to do what?
To spend $300K a year, you need
Did anybody grow spending with inflation first?
today.
What? Correct. Okay, so if my spending, when I retire in 8 years, I'm going to be spending what? 380.
You need 7.5 right now.
No. Okay, all right. You want to go with that?
Then you have to grow it at 1.03 to compensate for inflation.
Okay. What do you got?
Then you currently have 4 million, and you're going to grow that at what, 6.04%?
6.4, all right. Okay. 6.4.
Yeah. So you have 4 million, and then you have 8 years to grow that. So whatever that is. Is that right?
And it might be. It might not. I mean, does anybody want to?
No, it should be right because it just.
That should be right.
Because all he did was, instead of taking 380K and then doing the 4% at the end, he does it at the beginning. But it's transitive; it should work either way.
So what's that number? Anybody?
Yeah, it should be.
Is it 2.9?
2.9?
Yeah.
2.9.
All right.
Yeah, 2.93 million.
Okay. The really bad part would be if you're right and I'm wrong. That would really be a drag. Okay, so here's another thing here. Okay, so let's go with this 380, right? So, right, can we all agree that, 300,000 grown by inflation over 8 years is 380? Yes?
Nominal annual payment in 8 years.
Right. So I got a spending number of 380. Now I don't want, right, because I want my spending to be 4% of my value, right? I spend 4% of my principal. So did anybody come up with a large future value? Yes. You got all right. So this is basically 9.5 million, right? All right, so I've got my I. I have my future value. I have my present value, right? We know what that is. Right? I have my N. I now need my payment. Right? So the way that I would answer this question is I would say I need to save $292,000 a year. Did anybody get that right? Because that was how much do I need to save over the next 8 years? Assume I don't want to lose more. So I need to save $292,000 a year over the next 8 years. Did anybody get that? Does anybody disagree with this way of doing it?
But it's his number. You save that much. That's it. 2.9 million.
Yeah.
What's that?
Yeah, I didn't annualize it, but
Is it the same number?
It's the same number. Okay, that's just
You give me the same number. The pizzas are coming. I just, that's an equation I haven't seen in about 15 years.
I didn't put it as a certain amount per year.
Right, but he said he gave an answer. It's 292,000.
292. Right. That's the actual. The answers.
If you put 292 into as an annuity payment,
Yeah.
with the discount rate of 6.4%, what's the annuity payment for that? And that's 2.9 million. You're okay. The drums roll. Something like Nate has to go to the dollars.
It's pretty much the same.
It's going to, from a rough figure, you know it's the same. If you just do 10 and discount the growth.
Right.
You need to
Pretty much. I'm fine with that.
Is that what he's doing, Mike?
Yes. What's it, 6.4?
6.4 is the present value of that?
2.931.
That's exactly what I got.
1931 is the...
Is that a win?
That's a win.
You're the judge.
Okay, then I'm not biased, that's right.
Okay, so the pizzas will be forthcoming. Look, here was my hope. My hope was that I would at least, give you all a better idea of this industry, and to also let you know that it's not just a relationship business industry. It's not just an analytics industry. It's a combination of the two. So if you have interests in either and are willing to get better at the one that perhaps is your second choice, it's a great field. And, I can probably speak for Bruce here. I know it's growing in Florida. It's growing everywhere. Wealth management professionals are needed. I hope this was helpful, and good luck to everybody.